Welcome to the Anton Stetner podcast. And today we're going to be talking about the top 25 real estate investing strategies for 2025.
For 2025. So let's think about this. If you're the new investor or you're the old seasoned investor, we know that things are changing. We still have high inflation. CPI came out this morning. Ooh, a little bit hot, not so good. Unemployment, numbers not so good. Trump getting in, we got Trumponomics coming in, we got tax cuts. So we know that the investment landscape is ever changing. And then what should seasoned investors be doing? What should our beginners be doing? How is it evolving? I want to go through these 25 things. And this kind of breaks into a pattern of three, like where, what, and then how. So to start us off in the where, this idea of like, I want you to be looking in high growth metro areas. In other words, Austin, Seattle, Phoenix. Where are places that people are attracting the population? Where is business growing? Where does they have a strong economy and GDP? Where is there good rental demand? Where is there good appreciation potential? When we're in a high interest rate environment, we have to be looking for other ways to win, and appreciation is one of the ways you have to win in 2025. Item number 2, I want you to go look at secondary or tertiary markets. So for instance, if Seattle is the primary market, the secondary or tertiary market becomes Marysville, Everett, Lake Stevens, exactly where we live. I'm talking Boise, Idaho, Huntsville, Alabama, Chattanooga, Tennessee.
Those being cities outside of the major ones.
Bingo, the second level cities right outside. And you're looking for the same thing. We're looking for high cap rates. We're looking for good appreciation. We're looking for good job growth. The reason we're going to these second level cities, though, is they may be more affordable and there may be less investors there and we can possibly find a better return. Number 3, I need you to go find appreciating markets. Notice how I didn't say cash flow, brother. The reason I didn't say cash flow is interest rates are most likely going to be high throughout 2025. Fannie Mae's CEO said, don't expect rates to get below 6% in 2025. Therefore, we've got to be hunting for another metric. So our hood, good old Seattle, it's up over 8% since 2024, depending on how you measure it. That was in a high interest rate environment. So if you can find a primary or a tertiary market or a secondary market that's getting that high appreciation, if I can't get the cash flow due to the interest rates, I can at least make money on the property appreciation.
What's a couple examples of appreciating markets and ones that you think is going to depreciate off the top of your head?
Unfortunately, the depreciation is definitely happening throughout lots of parts of Florida, as they got hit. And then parts of Texas, you're starting to see some of that too, and some of the Carolinas. A lot of the appreciation is still happening on the coasts, in the high job growth areas, Seattle, California, in the Northeast. So basically the middle's kind of flat, the Southwest is kind of down, and the Southeast is definitely a little bit beat up too. Sorry, one more thing I wanted to add. We're already started doing this. We sold properties out of state in order to bring the money home to the Seattle Metro because we believe we're going to get good appreciation. And we have other videos here talking about how we're predicting the appreciation going forward. And guess what? It's still way above 5. Number 4, low inventory markets. You want to look for low inventory markets that also have other factors inside of them. The red tape of building, developing, high cost of construction, and low inventory, aka low supply. That low supply, even if the economy changes or interest rates stay high or inflation comes up, this is why these strategies are nimble, why they're moving around. But that low supply will help to maintain strong pricing in the face of economic headwinds. So low inventory markets is something to definitely be looking for. Number 5, Sunbelt manufacturing hubs. So this was started during the Biden administration. It's definitely going to keep going in the Trump administration. We are in the process of reshoring, bringing manufacturing home. So Arizona, Texas, the Carolinas, where the U.S. is going to get back to manufacturing, that's opportunities for investors. In that same vein is number 6, last mile logistics warehouses. So think of Amazon. I mean, have you ordered something from Amazon and had it literally show up in less than 24 hours?
Yes, like hours in some cases.
So what happens there is that warehouse is just somewhere right down the street. I want you to be looking at the major interstates. So I-5 is where we're at. You know, it goes from Canada all the way down to Mexico, and the major highways. And then how can I be investing in warehouses near there, because we know we're going to have more warehouse growth due to e-commerce. On that second one that relates to this exact same thing, but it's number 7 on our list, is industrial real estate. Same thing. On the major corridors, if we're bringing the manufacturing home, if e-commerce is blowing up, that we're going to need places for small business, big business, medium-sized business, and that's always in those industrial and manufacturing zones that are specifically on transportation hubs. Number 8, data centers. Okay, now how do I find a data center? You've got to go look for cheap power. So there's a whole bunch of data centers right in my dad's hometown of Quincy, Washington. Quincy, Washington is the proverbial middle of nowhere. But the Columbia River carves north-south right through that part of eastern Washington. So those gigantic hydroelectric dams sell cheap power up onto the top of the hill to Quincy. Microsoft's got data centers there. Amazon's got data centers. So what I want you to look for is, where's their cheap land, cheap labor, and cheap power. So expect more data centers. Also, what's the possible industrial revolution we're going through right now? What is it?
AI versus
AI.
search. Yeah.
AI is this new industrial revolution that we're going through right now. And what do those little computer buggers need? What do they need?
Computer chips.
And shit tons of power.
Yeah.
No, just an unbelievable amount of power to run all those NVIDIA GPUs together. So AI, cloud computing, and the internet in general, tech in general, needs these data centers. And I think this is going to be a great play. Number 9 on our list is opportunity zones. Trump, during his administration, passed the CARES Act, which created opportunity zones where you could put money out of a gain. It didn't matter if it was from the stock market or from real estate. You could put the gain into an opportunity zone, and you can look right on the HUD, the government's website, and you can find these opportunity zones. You could put the gain in there, and then if it was there for 10 years, you had no capital gains when you sold it. So it gave you an opportunity to defer all of a gain or part of a gain, plus then have a tax-free asset in 10 years. I believe we're going to have the CARES Act 2, and the Trump administration is probably going to push that through in their first 6 months, which is going to reignite these opportunity zones. They're in more areas than people think. There's one right up here in Smoky Point. There's another one over there in Everett. There's one in North Seattle. There's one in South Seattle. All they are is defined census tracts where the government wants money to go. Doesn't mean war zone. It means there's an opportunity there. As we switch over to the what, everyone, what did we miss in the where? Leave it in the comments below. Hit that magic subscribe button and like and share this with a friend who needs to be an investor. Okay, in the what phase, item number 10. I think single-family rentals are going to be extremely sexy in 2025. And I first got started in single-family ramblers, you know, your ranch, your one-story. It's the easiest thing to rent. It rents to the most people. So we have 4 properties available for rent right now. Unfortunately, December is always a hard time to rent. Out of the 4, 1 is a 1,300-foot rambler. We put that rambler up. Crickets on the half of a duplex, some okay applications on one house, okay other applications on the other half of the duplex. The Rambler, 15 applications in December, 3 well-qualified people, someone moving in 3 days. Boom. The reason I say single family is going to be sexy is We know a lot of red tape, except for in some overbuilt areas. So I'm generalizing here. There are a couple overbuilt areas in the South, so you got to be careful. That's why we want you looking at the inventory. But in the low inventory, good appreciating markets, your single family is going to out appreciate other types of real estate. Your single family is going to be the easiest to rent. And because homes have become so unaffordable, more people want to rent. But not everyone wants to live in a freaking apartment or in a townhome. So the single family rental is very sexy. It works really well right now. Item 11 is kind of in the similar vein. It's called a BTR, or a build to rent community. In other words, you buy the land and then you build the whole neighborhood for rent. Okay, this could be single family, it could be townhomes, but I'm not talking multifamily. So build to rent communities where the whole community is for rent. Very, very great thing to invest in. Number 12, we know everyone's being pinched by inflation. We know rates are still high. We know housing is unaffordable. Therefore, number 12 is affordable housing. How can you invest in affordable housing that's below the median price, that's below the median rent, so you have the absolute best demand? So you're making the highest price per square foot on the rent, and you're going to get the most appreciation when you go to sell it. Also, there's probably additional incentives like taxes or credits or grants for you to be able to invest in affordable housing. Number 13 on the list in the what category? Medical office buildings. So we work for and have done work for a very large medical developer in the area who does stuff for Everett Clinic, for Optum, United Health Group, all those people, all the big boys and girls. Is our population getting older?
Yes.
Is medical getting more expensive? I don't like this, but medical's getting way more expensive here in the U.S. And so we need more medical. We need more medical office. And what these things rent for is an unbelievable price per square foot. And then when you rent it to the tenant, they stay forever. And I'm also want you to be even thinking about like not just medical in general, but also like the dentist, also the chiropractor. Medical office, we like it.
Fun fact, my childhood dentist is still in the same spot, same building, and is still working on teeth. And he's wondering where I'm at, so I probably need to go back.
Yeah. That's a prime example. Listeners, hear what Benji just said. Think about your family doctor. Think about your family dentist. How long have they been there? And if they don't own that building and you were the landlord, you probably just rented them for the last 20 to 30 years. Number 14, senior housing. With our aging population, there are specific requirements for senior housing. There's senior communities, there's assisted living, independent living, all this stuff. But there's still more demand for senior housing.
What kind of housing should you look for?
I think it depends on the level that you want to get involved in. Later on the list, we have some passive ideas, but there's passive investing in this category. There's also active investing. And it's going to depend on the level that you want to get into, because if you want to get into like the full assisted living care, my dad, before he passed away, he had to go into one of those homes actually multiple times for multiple reasons. And it was between $8,000 to $11,000 a month for him to stay there. But that requires full-time staff, full-time nursing, things of that nature. It depends on the level that you're looking for. If you've got that level of expertise or could partner with someone, we know multiple people in the senior housing space that make a phenomenal return. Student housing. Even though we've been talking about the student debt crisis, nothing has changed. I don't see anything changing. We still have a high percentage of the population going to school. So how can you buy housing that is student housing? How could you build student housing? And once again, go back to the same qualifiers. Major metros or secondary markets, growing population, appreciating, good economy. And then I'm buying them within walking distance of the school. and I can provide a rent that is consistent with the market, you're going to have low turnover and be highly rented. Number 16, I personally do not participate in the number 14, 15, and 16. I have multiple friends, though, that do the clean and sober housing. And this varies from full treatment to I just got out of prison, just got out of rehab, and I need a place to stay. One, we know addiction and substance abuse, unfortunately, has been really growing here in the United States. So two, this is serving a huge need, and my heart goes out to the people who do this. But this is a very active style of real estate. There are good returns in it, but you realize you're getting into a very hands-on. My hands-on active stuff is land development. I can't take on any more hands-on things. So every time someone puts this in front of me and says, hey, do you want to do a clean and sober house? I say, absolutely not. I already have my active real estate investment. The rest of them have to be more passive.
But the reason you bring it up among the student housing, senior housing, is because there's a demand for it. And
Massive.
Sometimes there's some government subsidies that also help with revenue.
Huge. One of our friends just obtained a $90,000 grant for homes in Eastern Washington for her to purchase the home, and it could be used as down payment, furnishings, and or staff. She used this to purchase 2 homes that each one of the bedrooms gets converted into two living quarters. And she just purchased another one. So yeah, there's all kinds of grants for this stuff. That's why I mentioned it. Second, the demand is so high. She was telling me that she could fill another 30 beds right now if she had it, both in Eastern Washington and in Western Washington. So I just assume if it's like that in the rural part of the state and in the urban part of the state, this is a reflection across the rest of the country. Item number 17, suburban multifamily developments. Notice how I didn't say urban, because the cost of living is rising in those urban areas. We're talking about the secondary market suburban. We're talking about slightly more affordable housing. It doesn't have to necessarily be A class, but I'm talking like A class, B, B plus, not C. I'm talking build it from the ground up. It's nice and new. It's a blend of like affordability, attractiveness, amenities, jobs, things like that. I believe outside of the major metros, the second level markets are going to experience the best part of this, just due to like how many people are in downtown Seattle, homeless, things like that. Item number 18 goes hand in hand with number 19. We're talking the suburban townhome development. The thing with single families becoming so expensive. We talked about this on a previous podcast, and our subscribers hear this data from us. The median price in the U.S. right now is around $420,000. And unaffordability is at the second highest it was, or it's been since the early 80s. So lots of people want the single family home, but they can't afford it. But they don't want to live in an apartment. And maybe they also can't afford the single family rent. Townhomes are going to be a great thing. Also, in metros like ours, the Seattle metro, where they didn't expand the urban growth area, townhomes are becoming way more common. Here in the city of Marysville, we've had 2 ginormous townhome projects sell in the last 6 months. One was 140 units, and the other one is 230 units. For those of you who don't know, the Seattle metro is literally salt water on one side, Cascade Mountains on the other, so we got a lot of topography. This is not like Arizona or Texas. To put in even a 50-home subdivision is a big deal here. So when you get townhome subdivisions that are that large, they're major. That's the change in demographic. That's the change in affordability showing up. Okay, number 3, now we're moving into the how phase. Like, how should we do this? We talked about We talked about where, we talked about what. Now we're going to talk about how you should do this. And I kind of put like my favorite ones first. So we're going to go from my favorite ones, and then we're going to end in some passive ones that you may not have thought about. Commercial value add. And I bring this up with a smile, and it's a little bit of the Cheshire cat and also a little predatory all at the same time. Commercials beat up because commercial had their cap rates readjust, and they've had interest rates shoot up. So a lot of commercial values, depending on the sector, have gone down anywhere from as little as 5% to as much as 35%. So when I'm looking at commercial right now, if I can get something that makes sense today, keyword, in a good appreciating market with the good economy, with population growth, then I'm looking at A-class office space that I could buy and rehab. I'm looking at strip malls that I could buy and rehab. Now, I'm not talking the gigantic ones, the ones with the Sears and the Bon Marché that are going out of business, ghost towns. I'm talking the smaller strip malls that are like 2,500 to 5,000 square feet, and they're filled with things people need: the teriyaki place, the nail salon, the chiropractor, the laundromat. They're not going to get put out of business by Amazon. Multifamily, okay? If you're not catching it, I'm pretty pro multifamily right now. We're looking for multifamily that we can value add, that we can go through, we can add money to, and then get a higher cash flow or increase the value of the property. Same thing with townhomes. And that rounds out kind of our commercial list. Now, if you could find a warehouse that you could value add, absolutely do it. But realize warehouse is kind of fundamentally changing. A lot of the old warehouse, the slabs aren't thick enough. They don't have enough power for the high level of manufacturing we're doing and to hold all of the boxes and crates and pallets for e-commerce. So that old warehouse needs to be rehabbed and put into a new use. If you can figure one of those out, I'm sure you could also hit a home run. So then this next category, number 20, we're going to call it anything that creates inventory. Why? In the last 2 years of us recording content, we have talked about how the U.S. is just so far behind, approximately 4.5 million units behind, depending on how it's measured, in residential units in the U.S. So if you can flip a home, if you can build a home, if you can do the BTR, the build to rent, that's put the community together that you're going to rent, that's going to be massive opportunity in 2025. What you're going to run into is rates. You're going to need investors with cash. You're going to need more of your own cash. Things are going to require more cash than you want it to in 2025. So I need our people to slow down. I'm going to digress for a second. Let's say you have 10 deals in front of you. And if you don't have 10 deals, I want you to go find 10 deals. Because in 2025, with the high rates, you can only do one of them. You can't do 5 of them. You can't do 10 of them. So we're only doing the best deals, which means you have to negotiate more than you did over the last 5 years. You have to negotiate harder. You have to be willing to walk away. You've got to know that buy box and have that criteria so tightly defined that you can say this is a phenomenal deal and we're only buying good deals in 2025. So keep that in mind as we talk about the rest of this list. Number 21, this is really happening in Washington, and I know it's happening in a lot of other states. The middle housing. Middle housing is duplexes, fourplexes, sixplexes, and these DADUs, the detached accessory dwelling unit, also known as the backyard cottage, the old mother-in-law. We can't say mother-in-laws anymore. They're a protected class. And so we call them DADUs. But that's massive opportunity when the American public is telling you housing is unaffordable. Middle housing and these DADUs are alternatives that create units. Massive opportunity. Item 22 and 23. The BRRRR and the big boy BRRRR. A lot of you know what a BRRRR is. You're going to buy it, you're going to rehab it, refinance it, and then repeat. You buy it, you flip it. You need to get it approximately 30 to 40% under market value. You put 10 to 15% into it. You increase the market value, you refinance it, you hit your 75% LTV. Let's not forget about the big boy BRRRR and big girl BRRRR. The big boy BRRRR and big girl BRRRR is this idea of I'm going to buy the land, I'm going to redevelop it, then I'm going to reconstruct it. So I'm stretching on the R's here, bear with me. Then we're going to rent it, refinance it, and repeat it. If I can find a piece of land where I can create enough lift in the land to create that 75% loan to value, I can get a majority of that cash back. And if you do that in a high interest rate environment and it feels like, man, I'm barely making any money, but you did it in a high interest rate environment, that was actually a grand slam today. These last two are passive ones I want you to be considering and thinking about. REITs, real estate investment trusts, they got their butts kicked over the last year. And traditionally speaking, as the Fed starts lowering rates, REITs start recovering because REITs in general have a high cash flow position, a low loan to value position. So in other words, they have a lot of equity. So they should be set up for some good, steady returns. So you might want to look at some REITs. And last, but definitely not least, you want to look at some syndications. But wait, Anton, aren't syndicators getting their butts kicked? The syndicators that are getting their butts kicked right now are the ones that over-leveraged and have not been playing the game for a long period of time. They're over-leveraged and they're having to do cash calls and their assets are underperforming, and some of those LPs and GPs are going to lose their investment and it's going to go back to the bank. If someone's starting a syndication today, though, and we're already in the pain, and they have a track record of doing it, they probably know what they're doing, and they're probably going to be able to do quite well because we don't know where exactly we're at in the trough, but we're somewhere near the bottom. And everyone says, I want to buy at the bottom. Well, we're near it. It could be a good time to do syndications. We're always doing stuff with all of our investors, here locally. If you want to chat more about investing in the Seattle Metro, we'd love to chat with you. If you want to invest in one of the other metros, let us know. We have homies everywhere that we can connect you with. If there's something we missed in the where, the what, or the how, let us know in the comments. Drop your questions because we wanted to go over this very quickly for you and give you the 25 things you should be looking at for 2025. Thanks for joining us. And as usual, pleasure chatting.